This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
My name is Brad. I live in Central Florida. I'm here in Southern California for Jason's Empowered Investor event. This is my first event here, although I have been on 2 of his mastermind yacht adventures, which have both been amazing. But yeah, this event, man, it makes me feel like investing in real estate. We've gotten so much great information this weekend, from asset protection to how to manage properties. It's just a wealth of knowledge at this event here this weekend. So if you're thinking about coming to this event, I would highly recommend it. You're going to get a wealth of knowledge, whether you're a first-time real estate investor to a seasoned, experienced real estate investor. There's always something you're going to pick up from an event like this, and we'll hope to see you next time.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
Fellow Canadians, I come to you today with an urgent message and a call to action. Debt, inflation, immigration, crime, it's all out of control. The economy is in the toilet. We're dealing with a Trump crisis and a climate crisis. There's a lot on our plate. We understand that many Canadians are concerned about these issues and potentially shifting alliances to the evil, far-right Maple MAGA conservatives. Remember, our vision is long-term. And as we push Canada towards a net zero socialist utopia, now more than ever, we need to rally behind and unite behind a visionary leader, a man of impeccable international experience, a man who truly understands global governance. And that man is Mark Carney. He gets it. Mark understands that governance isn't about pesky elections or national interests. He's a Davos veteran. He understands that sovereignty is overrated and that real progress is made by unelected panels of WEF experts. The choice is simple. On one hand, you have Pierre Poilievre spouting hateful nonsense like justice, accountability, fiscal restraint, and capitalism. Those are all outdated values of the colonial patriarchy. We need a bigger, greener, more compassionate government that spends more, taxes more, and turns criminals loose. We only require another 75 years to turn Canada into a carbon neutral, post-national paradise. You'll have no freedoms. The country will be bankrupt, but that's okay, because you'll be a virtuous global citizen, because we said so. Now is not the time for your racist, selfish thinking. We need to unite against Trump, unite against the climate crisis, and unite against any other future emergency that we decide to create. Let us build a better, more equitable, eco-friendly Canada. Bigger, broker, beautifully governed. It's time to vote Liberal. Vote for Mark Carney.
He penetrates the cabinets.
Welcome, Empowered Investors. This is episode 2301, and thank you for joining us today. First of all, I want to express my heartfelt thanks to all of the condolences about my wonderful dog, Coco, who passed away just a little over 2 weeks ago. And, you know, everybody says their dog is special, and I agree, every dog is special. But the difference with Coco is a lot of you met her because she attended all of our conferences except the very last one, Empowered Investor Live. She attended my conferences for 13 years, even as a little puppy, and a lot of you met her. So anyway, thank you so much. I really appreciate all that. Okay, so today we have an interview I did just after Empowered Investor Live, and I wanted to be sure and share that with you, or just share a piece of it with you. And so that's coming up. But first, we have U.S. home sales increase, but the uptick could be fleeting. Higher mortgage rates are exacerbating affordability woes, analysts say. Well, did you really need an analyst to know that housing is unaffordable? Yeah, it's quite something. So a little bit of an uptick in the market for sure. We're kind of feeling that a bit too. But overall, I would still argue that we're in kind of this doldrums, right? When I took sailing lessons, and for those of you sailors out there, when I was sailing many years ago and doing beer can races and all of that kind of stuff, they have an expression when you are just in this exact wrong position, your boat is in the wrong position. They say you're in irons. I guess that came from the pirate days, probably. So when you're in irons, you can't go anywhere. And, the market is not in irons completely, but it is a little bit. And it has been for quite a while now. And that's kind of how it feels, just sort of not going anywhere very fast. Prices appreciating very modestly, but at least appreciating overall. And that's what we're in. But remember, here's the mistake so many people make. And I'll just remind you again and again and again of this, as I have before. And that is that it's a multidimensional asset class. And so if it's not about the sales market and it's not about big capital appreciation where prices are going up at a rate of 10, 20, 25% annually, right? If that's not happening, then what else is happening? As long as the population is stable or increasing, then we have a situation where those people, those would-be home buyers, are forced into the rental market if they're just coming out of, getting their first place to live as an adult, right? Or if they're in the rental market, they're forced to stay in the rental market, and that puts the upward pressure on rents. So as landlords, either way is fine with us. In fact, I would argue that the in irons market, where you're just kind of doing the boring but very fundamental, very important stuff of managing and hopefully self-managing your properties, then you are in a position to really, really do very well because you've got that modest appreciation going for you. You've got good cash flow and not a lot of new people coming into the buying market as sales activity is down, between 20 and 25% in most places. And that's a good time to just see your rents go up and your investments just solidify and get better and better and better. Most people don't think of that. All they do is they watch the sales prices and they are only seeing one little dimension of this wonderful multidimensional asset class. Okay, purchase payments. So mortgage payments, we don't talk about this very often, but our friend Mike was out with a new chart, and I wanted to share this with you. He doesn't usually share this stuff either, so this is kind of different, but it's really important to look at mortgage payments. So the typical single family home purchase payment, that's on a purchase, not a refinance or an existing owner, which has a much lower, cheaper payment, right? Because those people won't sell because their deal is too good to sell. So that's the mortgage lock-in effect we've talked about ad nauseum. But here we look at new purchasers and what is their mortgage payment. Well, as of this month, it's exactly $2,400 a month. And remember, that mortgage, that interest is deductible, of course. So, the typical home buyer tax bracket would be somewhere in the ballpark of maybe 30%. So basically, almost a third of that is being paid by the government, right? Well, let's just do the actual math here. Let me grab my calculator. Boy, it's amazing how little we can do in our head anymore, right? it's really scary. We'll take $2,400 times 70%, and that is $1,680. That is the real mortgage payment on average for most households, right? Just very roughly back of the napkin math. But it's even better when they include the equity pay down, which isn't included in that. The payment gets cheaper. And then, of course, the appreciation. The payment gets dramatically cheaper, even with low, moderate appreciation like we have now. So it's not a bad deal to be a buyer right now. And it just makes me think that a lot of it is just because prices aren't going up at this radical, feverish pace, human beings, they're not motivated by kind of this bland, relatively positive environment that we're in. They're motivated by fear of loss, right? If prices are going up fast and they are afraid they're going to lose out, that is going to be the most powerful thing to get people buying properties. But remember, when they buy a property for their first home, they move out of a rental property, okay? So it's not all good that the market is booming. A lot of times it's better that the market is just like it is now, just this kind of sort of partially in irons market, like we were talking about with the sailing metaphor a moment ago. And that's not bad at all. Okay, so that's the typical mortgage payment. And it's actually lower slightly than it was last year at this time. The mortgage payment is slightly lower than it was last year. Now you can see back in 2022, like in January of 2022, it was way lower. The COVID era brought us mortgage payments that we will likely never see again. Well, never say never, but until they manufacture the next crisis. Okay. All right. So available inventory. Inventory is just kind of the same. Not much changing here. 719,000 homes on the market in the entire country. It's 32% higher than it was last year, but last year was also historically low, and it's still historically low, only about half of the 2015 normal benchmark, right? That benchmark is old, it's out of date because we've added a lot of population since 2015, but what experts consider normal, about 1.4 million homes for sale, we're at half that. So inventory is still very, very low. All right, I talk about commandment number 3, thou shalt maintain control. And I advise you to whatever degree possible, if you are in the wealth gaining stage where you want to still accumulate wealth and not shift it into neutral and just kick back and give your money to the stock market, to the modern version of organized crime, okay, then you need to be a direct investor. That's how I made all my money with real estate, being a direct investor, right? That's where I got the best returns of all in my own businesses and my own real estate, that I was a direct investor. I was the actual owner of the property, or technically maybe one of my entities was the owner, but you know what I mean. Still controlled by me. And when I say be a direct investor, I say commandment number 3, thou shalt maintain control. You decide what to buy, where to buy, when to buy, how much to rent it for, who to rent it to, when to sell it, when to refinance it, whatever, right? It's your deal. You are in control. And when you're in control, you prevent the 3 major problems of not being a direct investor. Problem number 1, you could be investing with a crook. We all know the stories of all the crooks in Wall Street, syndication deals, cryptocurrency deals. I mean, there's just so many crooks out there now. I think a crook was pitching me on a deal just about 45 minutes ago, who called me up on some, I inquire about a lot of things, right? A lot of ads I see, I inquire because I don't want to know what they're up to. This is market research. I mean, and maybe occasionally I'll actually, do the deal and invest in it. But a lot of times I just inquire to see what's going on out there in the marketplace. And, this guy's pitching me on this autopilot business that I can give him, $35,000 to set it up for me. I am 99% sure that's a scam. And, when I say scam, it's like to one degree or another, right? There just aren't any really easy answers in life. Everything involves commitment, work, risk taking. You gotta take a risk, right? You gotta do things to create wealth and make stuff happen. So first problem, you might be investing with a crook. Second problem, you might be investing with an idiot. Third problem, when you are not a direct investor, they take a huge management fee off the top for managing the deal, whether it be the executives, the CEOs of the company, or the real estate deal, the sponsor of the syndication, whatever it is, right? They take a giant management fee off the top for managing the deal. And a lot of these fees that you are being charged that's reducing your rate of return are very opaque. They're very unclear. You just never really know all the ways you're basically getting ripped off. Well, I just wanted to share this one example. Okay, Brian Niccol made 6,600 times what a barista made company says. Okay. Since Brian Niccol was hired at Starbucks in September, it's hard to argue his competition hasn't been grande. A new company securities filing shows that the chief executive and chairman has collected $96 million, the Wall Street Journal reports, most of which was in bonuses and stock awards as incentives to accept the job. The company paid an amount that is, and listen to this, it's 4 sixes in a row. At least it's not 3. That would be satanic, right? 6,666 times what the Starbucks median employee, a part-time barista, made last year of $14,674 in wages, and they get stock too, right? The company said the Niccol's package breaks down this way. His compensation, a 61, and I'm going to round this off just for speed, $61,000 salary, $5 million bonus, and a $90 million in stock awards. The stock piece largely tied to shares he forfeited when he left Chipotle Mexican Grill for Starbucks. Another $5 million in bonuses is due Niccol's in February. Well, this article's a couple months old, so he probably got his $5 million already. Okay. Expenses, $72,000 for air travel. Now, actually, I think that one's actually a little bit low, to tell you the truth. I mean, assuming that's private jet travel, I don't know. Starbucks probably has a few private jets, and that's not included in this. So that might just be commercial travel. Who knows? Maybe he took, first class on Emirates to fly over to, the Middle East to check out Starbucks over there, right? And that'll be a $20,000 per person ticket right there. Who knows? He got another $144,000 in temporary housing and almost $700,000 for security modifications to his home. Wow. A $700,000 alarm system, fence? I mean, how do you spend $700,000 on security modifications? That must be a fortress. Okay, he lives in California and commutes to Starbucks Seattle office on a corporate jet, a perk he won in negotiations. So yeah, that tells us that the $72,000 in air travel does not include the Starbucks jet he gets to use. Okay, a perk he won in negotiations. The company said he's also traveling to areas where stores most need intervention. Okay, go have a latte in the most beautiful places in the world, right? So, this is it, folks. This is what's happening. If you were a shareholder in Starbucks, I mean, Starbucks is really having problems right now. They're on the rocks. The company is not doing well at the moment. That may change, of course. But all of these executives, and this is just the CEO, right? All the other C-suite people, they're just skimming the money off the top, folks. Okay. Even if you got a good return, say you got your, 8% return, right, on your stock, which would be fantastic. Even if you got that, you should have received 12%. There are so many ways they're just stealing from you. Too bad there's not a DOGE, Department of Government Efficiency, for these publicly traded companies, right? There should be. There should be a DOGE for that. Okay. Here's a chart that shows CEO pay is up 997% since 1978. CEO pay is up almost 1,000%. Now, remember, this is opaque, right? It's probably up much more than that when you include all of the different ways they're compensated. Many of them we just discussed. The percent change in CEO compensation, stock prices, and typical worker compensation from 1978 to 2014, okay? Here we show the typical worker pay went up by 10.9%. That's pathetic, honestly. That is just totally pathetic. See, this is where I sound like Bernie Sanders, right? That is just so wrong. The workers should get paid more, right? But it only went up 10.9%. The S&P, over that very long period, 503%. But the CEO pay, which in my opinion, should not be allowed to outpace the S&P. It went up by double that, 997.2%. Folks, thou shalt maintain control. It's my commandment number 3, be a direct investor. Do not get ripped off by crooks. Do not get ripped off by idiots. And do not get ripped off by people who just simply are charging big management fees and skimming the profits off the top that you should be getting. Okay, remember to register for our Wednesday masterclass. That's the second Wednesday of every month. Go to jasonhartman.com/Wednesday, and I, yours truly, will be hosting the masterclass this time. So we aren't doing a big guest or anything like that this time. It's me, yours truly, and I'm going to talk to you about how to extract wealth from your real estate portfolio and a bunch of other things. You'll be able to ask me questions in the flesh, in person, and it'll be great. So jasonhartman.com/Wednesday. This is totally free, no strings attached. We do it every month. jasonhartman.com/Wednesday. It's a Zoom meeting, so it's very open. You can ask me questions. I'll be happy to answer them on anything under the sun: self-management, financing, market condition, market projections, whatever you want to talk about. Okay, jasonhartman.com/Wednesday. And let's go to the interview that I was mentioning at the beginning. Here we go.
What's up, you guys? Welcome to another episode of RE Social Podcast. Today we have the one and only Jason Hartman. Welcome to the show, man.
Hey, thanks, Vince, for having me. It's great to be here in your very cool studio. And you've got the most beautiful musical instrument in the world behind me. That is the Gibson Les Paul.
Oh,
that
love
thing
that.
is gorgeous.
I'm cheap, so that's
I
an
own a
epic
few of
one.
those, and I don't even play them.
Oh, really?
They're just beautiful to look at. I mean, that is the most gorgeous musical instrument. It's way better than the Fender.
Yeah, I know, because I Slash uses it, so that's why I like it right there.
Yeah, it's good stuff.
Cool, man. So what are you doing in Costa Mesa for people?
Well, you attended my Empowered Investor Live
Second
conference
time.
over the last weekend for the second time, and we just finished that yesterday.
Yeah.
And you were there. You didn't get to play piano for us this time.
I know.
But
They
unfortunately.
didn't have it, unfortunately for us. But it was a great time. Met the big dogs like Mike Maloney and Russ and radio guys.
That's great. It was, we had some great speakers. We had Sharon Lecter, Mike Maloney. It was just a really good time.
We had a surprise guest yesterday. I met him outside.
I know.
Yeah.
We had Logan come in from Housing Wire.
Yeah.
I was texting back and forth with him for the week prior, and he was very non-committal.
Yeah.
And, it seemed like he might stop by. Then I just saw him standing at the back of the room.
Yeah.
I'm like, I got to get you up here.
Yeah.
So that was a nice surprise.
Yeah, I met him outside. I talked to Logan. I was like, Logan, please tell me you have investment real estate. What do you think?
No, he doesn't.
He doesn't?
No, I know. He's a total teacher.
Yeah.
It's kind of
He's
weird.
just like really into that stuff.
Yeah,
He doesn't
yeah.
own his own home, but that's...
Oh, he doesn't even own his own
No,
house?
he has his own home.
Yeah.
He lives here in Irvine.
But he doesn't, in Irvine.
Yeah, he
I know.
doesn't invest.
But he doesn't have investment properties.
That's
what I
isn't that
heard.
crazy,
Yeah.
you think?
Yeah, it is. But, hey, there are those who teach and those who do. And in a way, that makes Logan maybe more impartial.
Yeah.
Right? Because he doesn't have skin in the game, right?
It's not like us.
Which is kind of interesting. I mean, I'm an investor. I've been investing since I was 20 years old. I bought my first rental property.
Yeah.
I lived at home with my mom, and I bought a rental property.
Joyce.
Yeah.
Shout out to Joyce.
Yeah.
She's the best.
Exactly. Yeah, I had a rental property, and I was still living at home. I didn't buy my own house. That was the second purchase. I bought a condo for myself in Irvine.
Nice. Is that how you got into the game?
Yeah. I was 16 years old. I saw an infomercial for a real estate guru. I got his book. I read 3 chapters, put it down. Didn't finish anything at that age too much. And but my mom picked it up. She got really interested in the topic. Then about 2 years later, she said, Jason, you got me into this real estate stuff, and I've been going to seminars, reading books, and there's one this weekend by Disneyland in Anaheim. Why don't you go? So I rounded up a bunch of my buddies from high school and went to the seminar, and it was a whole weekend long. By the time the weekend was over, I was the only one there. All my friends had gone to the beach.
Did they ask you to run to the back because they were selling something?
Oh, they were always doing that. They were selling books and tapes,
Yeah,
cassette tapes.
Yeah, I know.
Back in the day.
Yeah.
But that was the start of it.
Wow, that's cool. And then you got into condos initially, or?
No, I don't recommend condos unless they're
yeah.
a great deal. I mean, and look, anything is great at the right price. Okay,
Sure.
But I like single family homes the best. I just happened to buy a condo as my first property to live in.
And then you started in California as well, right?
Yeah, in high-priced, overpriced California, but it wasn't so overpriced back then.
Yeah.
I mean, back then California didn't get too out of whack yet. That happened.
What do you think made California outpriced? Is just the ocean and?
Well, it's a restrictive building, and it's very hard to build something. There are a million regulations. It's a very dysfunctional environment in California. I mean,
You know-
politically and housing wise and everything.
Yeah. Let's challenge that, right? For you, you teach a lot of stuff. In fact, I met you a couple of years back and I started buying in Tennessee because of that. But most of my portfolio is here because of how California is, or any blue state, for example. They're very like not builder friendly, and they have a lot of these they have all these different rules and regulations and permits and stuff. That actually makes their housing price go up more, right?
Sure. No question.
Is that like a strategy we could use for people to buy, or not really?
Well, you can use that as a strategy, and many people have. Certainly, more restrictive building codes push prices up. No question. However, you're already paying a premium to enter that market, and you have properties that make 0 cents from a cash flow perspective. So you can't make a deal really work in California unless you're making that deal for speculation. And when I say speculation, I mean appreciation.
Yeah.
I don't want to rely on appreciation. It's not super predictable. We've certainly had it because the money printer has been on for, decades now, and we've had a very loose money supply most of the time. I like linear markets where the properties are sustainable and I can keep them for the long term. California, most of it, is a cyclical market. There are 3 types of markets I teach about: linear, cyclical, and hybrid markets. You know this, of course. The west coast of the United States is cyclical, pretty much all of it. The expensive northeastern markets, South Florida, where I lived most recently, in Palm Beach, Florida, those are very cyclical, meaning if you're looking at a chart of appreciation or depreciation over the years, they're like a roller coaster. They have glorious highs, ugly lows, and they're up and down. But the problem is when you get into one of those down cycles and you've got a property where the cash flow makes no sense, the property becomes unsustainable and a lot of people lose their shirt. And so the older I get, the more conservative I get, and the more I just want nice, sustainable investments that perform well. Nothing great has to happen. I mean, you've looked at our performas before, and anybody listening or watching can see those at jasonhartman.com in the properties section.
Yeah.
And those performas are just a 1-page, very simple performa. And you'll see that those properties perform with very modest appreciation predictions, vacancy built in, maintenance built in, property management costs built in. They perform at, most of them over 20% annually when you're considering all the multiple dimensions of income property.
Like mortgage pay down. And,
mortgage pay down, leverage, tax benefits, et cetera, right? So usually you'll see those like in the mid 20% range. That's good enough.
That's pretty good.
And sometimes it's a lot better if the appreciation's a lot better or the rents go up a lot more than you expect. It's going to be better than that. Certainly a cyclical market is the best. You hit the home runs in cyclical markets, but you also strike out. Because if you time it right, and you're really lucky, frankly, no one can time the market very well, at least not that I've met. But if you get lucky and you get in the lower side, and then there's a lot of appreciation, and you're smart enough to sell before the next cycle, you're going to do great. I mean, it's incredible. You don't have to have great cash flow. You just make your money off capital appreciation. The problem is I can't rely on that. I want the more reliable conservative investment that'll just work without any extraordinary appreciation.
And from your experience, Jason, I know you have a lot of these models. If you had to just throw a number out there based on appreciation, like hybrid, linear, and cyclical, what numbers are we talking about?
Well, interestingly, and I've got to find this slide. It's an old slide, PowerPoint, and I don't even use PowerPoint. I use Google Slides. But many years ago, I used to show this at my seminars in 2004, 2005, 2006 range. What it showed is it compared a very cyclical home run market, or I think it was Orange County, California, if I remember correctly. And it was either Kansas City or even worse, that I would not recommend, but Flint, Michigan. I think it was,
no.
Yeah, I know. Yeah. I mean, I've never invested in Michigan, okay?
But I saw Obama drinking water there, so we should be good.
Yeah, don't drink the water. That's not funny, actually. But and you take a very cyclical market and a very linear market, and this was just over, I think, an 18-year period. Now, of course, you can adjust the time and the number will be different. I get it, okay? But it's interesting because over that period of this survey, and it was done by First American Title.
Okay.
They have a
Yeah,
big economics
yeah.
division, and they have economists that work for them and stuff. And they do some great reporting, by the way. I like First American stuff. Orange County actually appreciated at 5.4% by the time you take the ups and you give back on the lows. The average was 5.4%. And this linear market, which I think was Flint, Michigan, it was like 6%.
What?
Yeah, it actually did better because you don't give anything back in the lows. And a lot of people that follow the stock market talk about this, right? They say, okay, if you buy a stock for $100 and it goes to $50, you lose $50. You lose 50%. But to get back to 100, you have to gain 100%.
Yeah, I've heard
So
that.
that's just kind of the way the math works. When you have these markets where you have to give back a lot in a cyclical downturn, that's pretty tough to climb out of,
Yeah.
So the cyclical, it could be good, but if it doesn't work out, the cash flow is never going to work. So it's a very speculative investment. I don't gamble. I don't like gambling. I don't think speculation is really a strategy. And what I'm really talking about here is the primary focus of your wealth creation.
Yeah.
Listen, I will be the first to admit, I take a few cyclical bets, or not cyclical bets in real estate necessarily now and then, but I take some speculative bets. I own Bitcoin, I invest in all sorts of things, okay? Startups, all kinds of crazy things. And,
But it's a very small percent of your,
Yeah,
what would you
it's
say
just
real estate is in your net worth percent?
Well, I would say for anybody, it depends how wealthy you are, okay?
No, that's true.
Look, if you're worth $50 million, you can afford to speculate with 40 million if you're crazy. Okay,
Yeah,
you'd be
yeah,
crazy,
that'd
but
be crazy.
but you could do it, and it really wouldn't affect your lifestyle probably if you lost it all.
Yeah.
Okay, but for most people, the speculative part of your portfolio should only be about 10%. Okay, that's what you do with 10%, and if you get a home run, it could be huge.
So you would never keep 70% of your portfolio in like a California market then?
Oh God, no.
Yeah.
way.
It's just risky, huh? It could go down any
Yeah, no,
time.
listen, we don't recommend California. We've never sold California. When I was in traditional real estate before 2005, okay, when I sold, I had a local company here in Orange County. I sold it to Coldwell Banker in 2005, okay? But, in my investment business, which is a nationwide business, I've never recommended California. It's just not a conservative, sustainable type of market. But I've never recommended New York or
New York, nobody.
Miami or any of those,
Yeah. Even Miami, huh?
God, no. Miami's very cyclical.
And very high, even though it's in a red state, huh? Because
It's not just about the state. There can be high-flying cyclical markets in conservative states.
that's true.
Like most of New York is a state, right? Not the city.
Yeah.
And New York State is very linear.
Oh, really?
Well, sure.
Like Rochester.
Albany,
Yeah.
Rochester. I used to live in Rochester, okay, when I was a little kid. That's a very linear market.
Buffalo?
So, Buffalo, all that. That's where my family's from, between Buffalo and Rochester.
Really?
Yeah, in
I
upstate
didn't
New
know
York.
that. I thought you were from here.
No.
You just grew up here.
Well, I grew up here most of my life. Yeah, in
that's
Los
cool.
Angeles.
So, for people who are listening, a lot of the newer investors, how does, like your company where you actually provide turnkey solutions, and how does that circumvent some of the problems that we have? Do you actually have advisors? You advise people or?
Oh, yeah, of course. Basically, the company you're referring to, I have several companies, but the company you're referring to is Empowered Investor.
Yeah.
An Empowered Investor basically teaches people how to invest in real estate in a conservative way. Okay, it's a boring, conservative way. We're never going to make the news, with this strategy. It's just buy and hold rental properties, turnkey rental properties, buy them and hold them, and grow your wealth slowly but very reliably. And that's what we do. We teach people how to invest. We provide a network of sellers that people can buy property from. We vet these markets, we vet these properties, we vet the sellers. Then we recommend them to our clients. They can buy them. And then we offer ongoing support and software to help our investors.
How about
along the way.
management?
Yeah, we either recommend property managers, but we really recommend self-management.
Why is that?
Because property managers mostly are just not very good. In fairness to the property managers themselves, the ones that aren't just bad people, and there are lots of those in every industry, but it's hard. The property management role is a role where you're trying to serve two masters, and you can't serve two masters. And what I mean by that is you've got the landlord, the owner, the investor that is your client. That's who you're really supposed to serve.
Yeah.
But in reality, in practice, you're also serving the tenant. And those two parties are at odds sometimes, right? And when you put this third-party middleman in between the two of you, we find that it usually is actually more difficult when you've got the third party with their own agenda, the property manager, right? So we recommend that people self-manage their properties. And if you asked me if this could be done remotely, long distance, before 2008, I would have told you you're crazy. Okay. When I owned local properties, when I lived here in Orange County and I owned properties locally that later I realized they didn't make any sense, okay, because they weren't in linear markets and they didn't have cash flow. But actually, they were better from a cash flow perspective back then. Nowadays, they're so out of whack, okay? They're just really out of whack because the rents just don't keep up with the appreciation. Okay, the rents always lag appreciation. So when I started being a nationwide investor in the early 2000s, okay, I always had property managers. And most of them were pretty good, some weren't so good, okay? And some I fired and got a new one, right? But one time, I had this property in San Antonio, Texas. I lived here in Newport Beach. I had never seen this property. I never met the tenant. I didn't know the tenant's name. Okay, I had a whole bunch of properties in different states around the country, 11 states and 17 cities at the time. And the property manager said he was getting out of the business and retiring. And my assistant, Karen, in our office here in Costa Mesa, right down the street on Anton, okay, she started finding new property managers. And she found one that she recommended to me. She put their property management agreement on my desk, and I just never got around to signing it. I never got around to even looking at it. The first of the month rolls around. In my mailbox, I get a nice little card with a check and a handwritten note from the tenant. And the tenant says, "Hey, Jason, I heard I'm supposed to send the check to you, because the property manager got out of the business. And if you need anything, here's my number and my email address." And I'm like, okay, great. So I just became an accidental self-manager. Turns out I self-managed that property for like 12 years.
What?
With multiple tenants. Okay. And I've self-managed lots of properties since then because you don't need to be there locally, especially nowadays with the tools we have, with the technology, with the internet. It is so easy to do this remotely. And the danger of having a local property that you self-manage? I guarantee you will end up becoming a handyman.
You just start going and
you just will not resist going over and doing the work yourself.
I do that
sometimes,
a lot.
or meeting the contractors and all that kind of stuff. So it forces you to be an investor, right, and not be a handyman, right? And that's one of the great things about it. It forces you to do the job right. So self-management. We teach remote self-management, and it works great.
And is not to mention like another 10%, right?
You'll get a whole bunch more of your income, but not just, property management fees they're misleading because the property manager will say, "Hey, I charge 8%, for example, right? 8% of the monthly income is what I'm going to charge." But that's not true. I mean, this. I'm saying this for the listeners, right? The property manager will typically, if they charge the tenant a late fee, they'll keep it. Because they'll say, "Oh, look, we had to go chase the tenant for the rent." So we're entitled to the late fee. And then they'll mark up the repair and maintenance costs. And then they will charge other fees. They just kind of nickel and dime you, okay? And so they really do charge more. And also, they tend to not treat the tenants that great. And the tenants don't stay as long. There's more turnover. There's less longevity to the tenant. And if you are self-managing, and we have clients, by the way, that are doing this with large portfolios of almost 200 houses, okay? And I helped this one client that I'm referring to, who remained nameless, but he does live here in Orange County, okay, nice. In Newport Coast. And basically, he has a staff of like 1.5 people managing his portfolio. Okay. I helped him do that. I helped him hire the people. We picked the software they were going to use to manage it. We set up some things to make sure that the money is handled properly and that there's no fraud or embezzlement and things like that. It works great. So you can self-manage, a dozen properties yourself quite easily. You'll probably talk to, or when I say talk, I mean communicate with, like an email back and forth or maybe a phone conversation with your tenant maybe once a year. You know, it's
And
just,
how many
it's just,
properties-
it's just really quite easy.
How many properties do you think a regular person can take on?
Well, you know, once
If they have a full-time job like me,
yeah,
let's
yeah,
say.
yeah. Once they set up their, you know, their system and they get the software, and we recommend the software for them, and we help them work with it and so forth, and get it set up, one person can easily manage 20 properties.
Yeah, we talked to Dana, right? Dana?
Dana was at the conference.
Yeah, what was her,
that's just one of many softwares that we recommend.
Okay.
But that's a good one, and I use it. You know, there are just tools that make this very easy. It's not hard. I would say that all in, for all of the things you have to do with a property, amortizing and just averaging over the course of, you know, maybe 5 years, right? That you will not spend more than 1 hour per month per property. I would be surprised if you spend that much. And I mean the bookkeeping, the paying the mortgage, you know, of course you're going to set that up automatically, but just, you know, keeping track of things, looking at the insurance, looking at the HOA, all of that stuff.
Yeah. So the markets during COVID, people were flooding to, you know, Southeast. It's 2025 now. Is it still the case, or are people coming back?
It's definitely not what it was.
Yeah.
I mean, you know, I predicted that. Look, all my predictions, everybody, all they have to do is go back and listen to the old podcast. They're date stamped. They can't be changed. The YouTube videos are there. I can't change them.
Are you the longest running real estate podcast?
One of them.
You know, like 2000, right?
2004.
Yeah.
Yeah. And, you know, you can hear that my predictions pretty much came true, you know, most of them. Yeah. And I predicted that mass migration. I compared it to The Grapes of Wrath, the book by John Steinbeck, who wrote about how we had this mass migration in the Great Depression.
Yeah.
And I said that would happen when the COVID lockdowns lifted. And people would move to these suburban type markets that were lower priced, that weren't psychotic about COVID with the mask mandates and all that kind of stuff. And it happened. And Florida was probably the biggest recipient of that, as people left mostly New York for Florida.
Yeah.
Okay. And now, you know, Florida has had a major impact from that. And, you know, some people are leaving, but not in any kind of mass numbers that, you know, you should be very worried about. Every market, you know, it's just a cycle, right? Whether it be price or population, you know, everything in life gets like exuberant and gets out over its skis, as the expression goes. You know, you get out over your skis, right? And then, you know, it kind of backpedals a little bit and then reaches kind of an equilibrium.
Yeah.
That's what Florida is doing.
Yeah. So you're saying it's still a net positive in those kind of southeastern states, Georgia, Tennessee,
completely.
Alabama, North Carolina, South Carolina.
Yeah, you don't have to ask me, just look at the stats. I mean, they're there, look at the census.
Yeah, Kenny, your buddy always says, look at the U-Hauls.
Yeah, by the way, that's a great advice. You know, I've been talking about that for 21 years, okay? U-Haul, you know, they release the data on where their trucks are going. And you can just go now to uhaul.com and you can put in, you know, Irvine, California, and how much it is to rent a truck to go from Irvine to Phoenix, and how much it is to rent a truck one way coming back.
Yeah.
Those prices will be very different.
Very
and
cheap to
it
come
shows
back.
you where the migration trends goes, okay? And I used to subscribe about 21 years ago. I used to subscribe to a service called promover.org, I think it was. I don't even know if it's still around anymore. And it would show you all of the big 7 moving companies.
Yeah.
And it would show you every stat on every truck of theirs, where it was going and where it was from, where it was originating. And so amazing data. The movers, you know, that's amazing data.
Yeah.
And so U-Haul has on their website press releases, articles, stats about, you know, and
You know, another thing I wanted to talk about is, you know, what we're talking about is, I would assume most people never get to realize or exercise, like, you know, buying income properties and all of those different things, right? Now, did you just happen to figure this out, or did you happen to meet Robert Kiyosaki along the way or something? Or?
Oh, I'm way before Kiyosaki.
Really?
Okay, yeah. Kiyosaki was in the 90s. I started long before Rich Dad, Poor Dad
Okay,
came
so
out.
you just did this by yourself?
No, I read Robert Allen's book.
Robert Allen.
Creating
I
Wealth.
like,
That's
Robert
why-
G. Allen. Yeah.
Yeah, that's why my show is called Creating Wealth.
Oh, okay.
Because I read his book, Creating Wealth.
Did you
3
ever meet
times.
him?
Oh, yeah. I met him many times. Yeah.
Oh, nice.
Yeah.
So
It's funny, and my mom even commented, because I gave a speech about 6 months ago in Tampa, Florida, and Robert Allen was in the audience watching me speak.
Oh, wow.
And my mom said, boy, that's quite a turn of events.
Yeah, he's a cool guy.
Yeah. Oh, yeah.
Is he the one who went to a state and he said, I'll get 3 deals done?
That was his big PR stunt.
Yeah, and it worked, right?
Yeah, it did. Well, apparently it did. He challenged he challenged the LA Times, or he put out a challenge and the LA Times called him on it. Okay. He said, send me to any city with $100 and take away my ID and everything. I'll buy a house in 24 hours. And he did.
Yeah. That was kind of cool. Yeah. So you started there, and then how did you end up meeting George and Kenny and all these guys?
Well, Ken McElroy, I met, 17 years ago. He was on my podcast.
Okay.
And then he invited me to meet him for breakfast.
Oh, wow. Okay.
That wasn't that was maybe 15, 16 years ago.
Okay.
And then George Gammon, one of my clients was watching his YouTube channel and said that he was talking about me. And I just kind of ignored it. And then, he sent me another video and he said, this guy is talking about you all the time. And then he sends me another one and he says, he's talking about you and your inflation-induced debt destruction strategy.
Yeah.
And he says, and I said, okay, put me in touch with him. And then so George had me on his show. And then, I said, hey, I've never been to Medellin, Colombia. I want to go. I'll come down and meet you. And so I went down there and visited him, and that was in 2018 maybe, or 2019.
So you would say having this platform, helping people, achieve financial freedom and stuff has actually helped you reach all these different people?
Well, I wouldn't say the business did, but I would say the podcast.
The podcast, the podcast is what I meant. Just, having it out there and people listening.
Sure.
And then finding people. That's kind of interesting, right?
Yeah.
And what would you say in 25... And, we talked about Kenny, and he's all in multifamily, and we are strictly single family. And you stayed with single family. You till now you're just single family, right? 1 to 4 units.
Well, I've owned some multifamily properties. So here's my experience with larger deals. Okay. My first large deal was a 125 unit apartment complex that I bought with a client of mine. And he put in his money, I put in mine. We bought this property. Then we sold that property and did a 1031 exchange and bought 2 more. One was a 139 unit apartment complex in Oklahoma City. And then another one was a mobile home park about 90 miles south of Las Vegas that I still own. Okay. Those were my biggest deals. Smaller deals, I've had some 14 unit and 10 unit apartments, little apartment complexes, little mini ones. That's my experience. But the rest is mostly just single family homes. And I love single family homes. They're the most proven, most simple, most accessible thing for the average person. Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.